4. A comprehensive financial plan. To start your financial planning, you will need to create both short and long-term financial objectives based on your risk tolerance and time horizon. You must begin with an end in mind by creating an annual budget, detailing all your income and expenses, and designating specific amounts to be set aside for monthly investments. Here are the types of investments that you will want to consider as you launch your financial planning and build a portfolio. Investing monthly. This is highly recommended if you want to build and grow an investment portfolio. Your short-term investment portfolio should have 6 to 12 months of cash to cover emergencies and/or unforeseeable circumstances, such as becoming ill or losing a job. One of my clients recently lost her job, and she was able to use the funds available in her short-term portfolio to cover her living expenses while she looked for another job opportunity. Short-term investment alternatives offer liquidity. Some deposit accounts let you access your money immediately, although they may charge a penalty for early withdrawal. What's more, some investments are simpler to exchange into hard cash than others. Be that as it may, these ventures don't shield you from inflation, which has averaged around 3% in the course of the last 25 or more years. Investing money consistently includes some level of risk, regardless of how little. Yet, when you do not invest, you don't risk loss, you guarantee it. Some of the safest short-term investments include high-yield savings. Savings accounts are insured by the federal government through the Federal Deposit Insurance Corporation, FDIC. Your first $250,000 is secure. Most banks pay nothing or basically nothing on savings accounts. However, some banks offer a higher yearly rate contingent upon current rates. For example, a 12-month certificate of deposit, CD, offers a higher rate. Ask your bank what the current rates are for money market accounts, MMAs, and find out what the withdrawal restrictions are. Treasury bills are fixed income investments sold by the U.S. Treasury, with maturity periods extending from a couple of days to as long as a year. The greater the maturity, the higher the interest rate. Additionally, consider investing in Treasury inflation-protected securities, TIPS, to shield from inflation. TIPS are a type of Treasury security issued by the U.S. government that is indexed to inflation to protect investors from a decline in the purchasing power of their money. As inflation rises, TIPS adjust in price to maintain their real value. Exchange-traded funds, ETFs, hold assets such as stocks, bonds, or commodities, and they are low-cost investments traded on stock exchanges. Bond ETFs are a type of exchange-traded fund, ETF, that exclusively invests in bonds. These are similar to bond mutual funds because they hold a portfolio of bonds with different strategies, maturity rates, and the yields vary accordingly. A mutual fund is an open-end, professionally managed investment fund that pools money from many investors to purchase securities. Long-term mutual funds offer diversification and opportunity to grow your portfolio. There are many types of mutual fund investment opportunities that you can select, again depending on your risk portfolio and time horizon. Check your portfolio at least once a year. If your current asset mix differs from your target by 5 percentage points or more, rebalance. Portfolio rebalancing is the process of making changes in your existing portfolio so that it matches the currently recommended/desired portfolio for you. There are many other categories of mutual funds, including A. Equity funds, invested in stocks that are either actively or passively managed and/or categorized by industry, geography, etc. B. Balanced or hybrid funds, invested in both equity and debt instruments. C. Index funds, or exchange-traded funds, tracking a specified basket of underlying investments, such as the S&P 500 or the Dow Jones Industrial Average. And D. Specialty mutual funds, invested in securities of a particular industry, sector, type of security, or geographic region. Which of these funds is best for your portfolio depends on your overall financial objectives. The more youthful you are, the more your portfolio ought to incorporate equity funds, as you have more opportunity to adjust to the inescapable ups and downs in the market value. Equity mutual funds offer portfolio diversification in different ways, relying upon the objectives of the funds. Some funds focus on large caps, mid caps, and small cap companies, which refer to the company's market capitalization. Large cap fund, companies with a market estimation of more than $10 billion. Mid cap fund, companies worth $2 billion to $10 billion. Small cap fund, companies worth $300 million to $2 billion. Industry or sector funds are centered around specific industries such as technology innovation, oil and gas, aeronautics, or healthcare. For example, investors who want exposure to gains by companies like Google and Apple could invest in a technology fund. Ownership in various sector funds can help differentiate your portfolio. So if one industry is hit hard, like the dot-com stocks in 2000, those losses can be counterbalanced by gains in different sectors of the economy. Growth and value funds are another mutual fund differentiator. Growth funds look for stocks that fund managers believe will have superior returns. Value funds search for organizations whose stock is underestimated by the market. International, global, and emerging market funds can likewise decide how a mutual fund can be composed. For instance, international funds invest in companies doing business outside the U.S., while global funds put resources into organizations working in the United States and abroad. Emerging market funds target countries with small but developing markets. Bond funds are the most common type of fixed income mutual funds. Rather than buying stocks, bond funds invest in government and corporate bonds. Investors approaching retirement age often have a large percentage of their portfolio invested in bond funds. As you approach your retirement, you will need a predictable income, and one of the classic ways to receive continual cash flow from investments is to set up a bond ladder, a bond investment with different maturity dates. You can invest in individual bonds, certificates of deposit, and exchange-traded funds with different maturity dates to allow you to anticipate an income stream from your fixed income portfolio. Vanguard founder Jack Bogle suggests buying into low-cost, low-fee bond index funds that spread out your risk because you will own every part of the bond market. Money market mutual funds are fixed income funds that invest in short-term debt from governments, banks, or companies. These funds include assets such as U.S. Treasury bills, certificates of deposit, and commercial paper. They are viewed as the safest investments and make up 15% of the mutual funds available in the marketplace. The income generated from these investments is either tax-exempt or taxable, depending on the specific investment. All mutual funds comply with the federal regulations based on quality, maturity, liquidity, credit quality, and diversification. Balanced or hybrid funds are a blend of equity and fixed income assets with a fixed percentage of investments. For example, a conservative fund would be composed of 65% stocks and 35% bonds. The equity portion offers capital appreciation, while the debt portion offers security. One of the most popular balanced or hybrid funds are target funds, which reallocate the percentage of equity to bonds the closer you get to your retirement. Target funds can be conservative, moderate, or aggressive depending on the nature of investments held in the portfolio. Investors choose balanced or hybrid funds depending on their retirement plans. For instance, a retired person would choose a conservative fund because the investor cannot afford to risk their retirement money. Target funds are expensive and may also be more aggressive or volatile than you may want. If you want to invest in a target fund, check out a low-cost provider like Vanguard. Also, I want to remind you that you can create an asset allocation based on your risk tolerance and objectives instead of paying target fund fees and reducing your return on your investment. Keep in mind to diversify through low-cost index funds. For example, if you are in your 80s, the general rule of thumb is to have 40% of your portfolio invested in bonds. But if you are in your 30s, be invested 100% in equities. Index funds can vary by sector, location, and size. It is not recommended to invest in just one market, e.g., emerging markets. It is prudent to invest in a well-diversified portfolio, which may include 30% US, 30% Europe, 20% Asia Pacific, and 20% in emerging markets. Alternative funds are multifaceted investments that include hedge funds, managed futures, commodities, socially responsible funds, and real estate funds. Before investing in these funds, investors should do extensive research to find out the risk and the returns expected in each of these funds. Alternative funds are more complex than the conventional mutual fund strategies. Alternative funds can achieve higher returns, but they also have higher risks. Also, they require higher minimum investments and a longer maturity date. In summary, there are many investment choice alternatives, but you must select those investments that will meet your desired financial objective, risk appetite, and time frame.